Hey everyone, this is Michael Bengiat. This is the Market Trend Advisory weekend video for July 2nd, 2022. Hope you're all having a great 4th of July weekend. Let's go ahead and get started. Here's our disclaimer. You can read it by pausing the video. So we had a couple changes this week in terms of the trend. On, I think it was Tuesday, we went back to a uptrend uncertain from a confirmed uptrend, which we had started the week prior. But the market, we'll show the chart in a second. The market just came down and enough damage was done that we've returned back to an uptrend uncertain, which is basically uptrend under pressure. That knocked our small exposure we had into the market for the indexes down to zero again. And so we currently have no exposure on either the NASDAQ or S&P. We do show a little bit of exposure you can have for the individual stocks or non-index ETFs, because there are quite a few leading stocks that are acting quite well, and it's been improving a little bit this last week. And for anybody that's new or you're not really kind of watching this, a lot of times the indexes may be acting poorly and stocks may be acting actually pretty well, or vice versa. We did see this the opposite. Is the indexes were holding up for much of 2021, and of course 2022 he started the bear market, but underneath the surface the stocks were just acting terrible, especially in the NASDAQ. We had major tech carnage, growth stock carnage going on, while the indexes actually looked pretty good, and it's because they were being held up by the handful of huge mega caps. So that's all changed. Most of those stocks now are in bear markets themselves, and the whole market's rolled over into a bear market. So the market's trying to bottom here. So we will see in a second. We'll look at the charts. Just briefly, investing strategies. We are out of the market again. Overall, our composite, we're just down about less than 12%, 11.88% for the NASDAQ, 12.7% for the SPY. This composite strategy just means that we're actually only using the market count 1x strategy because we are down for the year in the indexes and in a bear market. So you can see that we are handily beating the buy and hold for both QQQ and SPY, especially for QQQ, which is almost down 30%, and the SPY is almost down 20%. So, but it's in a bear market, it's tricky. There's a lot of these rallies that get the market going, which kicked our system into play because it's a trend following system just to be kicked out. So this is why it's bear markets are dangerous. It's very tricky to navigate them. But having a system like this does work. It has minimized the pain, and that's all really the best you can do. You're trying to just, if you're in the market, just to lose as little as possible, and or just be out completely until there's clear waters. But it's difficult to know when the clear waters come, especially in a bear market, because you get a lot of these fake out rallies. So here's the NASDAQ. So you can see here, we started on this day right here with the potential rally day. On day 5, we got the follow-through day. You can see here this strong up day. So it looked like it was going to be, maybe this rip-roaring rally we've seen in other times. And we also got above this declining 21-day. The fact that all the moving averages are declining is, concerning. So there's a lot of what we'll call overhead resistance. As the market tries to get back up here, all these people that were here, are either still holding and have massive losses or just are been hurt. And so as it comes up here, these people are trying to get their money back. So that's what's called overhead resistance. So it's a slog for the market to really get higher and higher, because a lot of these people are going to be taking profits. It acts like a lid on the market, just kind of race off. And of course, when you're in an uptrend, when you're over here, when the market continues higher, there's no losers, at least in the indexes. So this makes it a little difficult. But you can see, so we had one day we held above this 21-day, and then we broke below it, knocking us back into the uptrend uncertain. So again, market on Friday looked like it's trying to bottom here. You can see this little bit of churning going on, and but we don't know. I mean, the odds are not in the market's favor at this time. But remember, the markets are always discounting and looking forward to the future. And every single tiny report that comes out, it's being parsed and taken apart and to see what does that mean going forward. So here's the S&P, same thing. We had the follow-through day. It looked even stronger on the S&P. It was a bigger day, massive volume. Now remember too, one of the things that was a little caveat for both of these, NASDAQ too had nice strong volume, is that we had the the Russell rebalancing on that day, which really just massively added to the volume. So without that, the volume I think was even a little bit below the average volume, so we wouldn't have even had a follow-through day. So we would never have even had any rally in terms of our system. We would have been still out. So, but anyways, there's always little things that happen in the market. So it made a little suspect, and of course, it has not failed completely, but we did take out the low of the follow-through day for both the NASDAQ and the S&P, and that did knock our system back down to zero, so there's no exposure. So briefly looking at the technicals, the market's just in bad shape. I mean, just looking at the 52-week highs and lows, we have, if we go back to June 9th, we have double digits highs, and look at we have triple digit or 4-digit lows. So even as the market's trying to make its way up, the lows are just outpacing the highs, by a ton. You can even see it through the ratio. We've gotten down as 0.01. So we are solidly in the red here. This has been improving. The NASDAQ percent above its 50-day and 200-day. But the 50-day is improving because it's a little faster moving, but we're roughly bound down 20% off of the 200. It's a weak market. And going just over here, the percent of stocks above the 200-day, under 20% for most of the last few weeks. That's really pretty poor action. So again, what I was talking about with the individual stocks, we are seeing an improvement in the number of leading growth stocks that have broken out and have not failed. And the failing means that they haven't gone down 5 to 8% below their sort of pivot breakout price. So not so good on the technicals. And then on the sentiment, it's kind of a little bit of a mixed bag. It's overall we are bearish, but we're starting to see the Investors Intelligence Weekly bulls and bears. It's starting to come back up. We are still more bears, but we're starting to increase the number of bulls, lessen the number of bears. So we did cross down here, and so that did give us a sort of a buy signal, which the market, in conjunction with other signals, did put on a sort of a relief rally. But we're still in extreme fear. So this is still set up to sort of propel the market higher, because in contrarian terms, when everyone's bearish, there's really no more bears, and so the selling is considered to be over, and that's why the market would have at least from sentiment point of view, would be able to go back up. But that's we expect that because we are in a bear market, we're going to see even more extreme, sentiment on the downside before this is maybe over. But not always. Sometimes markets just kind of end. They just stop going down, especially if it's a prolonged bear market that lasts more than a year. Anything else we can talk about here? The VIX has just been a very odd one for a long time. It's been solid red for just months and months and months. So, but we put them all together. We are still on the bearish side, but probably not enough to kick this over. For example, at the bottom of the 2020 coronavirus crash, the CNN fear greed hit 1. You can't go any lower than that. So we had pretty black sentiment there. But in others, if you add this all up, a lot of people feel like the sentiment is actually blacker, more pessimistic than almost any time in history, including the bottom of the NASDAQ's crash in 2002, the financial crisis in 2009. So, and this was coming in when we haven't even declined all that much. I mean, the S&P's just at a bear market level and kind of trying to stave it off, but see if it can do it. So finally, just a few things what to look for in July, the important things. So the first thing is the earnings reports and guidance. So already a lot of companies have issued disappointing guidance going forward for the rest of the year. And that's, of course, added to the risk-off stock mentality that's going on because everyone's concerned that there's going to be a recession. So the thing to watch out is that not next week, but the second week of July is going to be the second quarter earnings season is going to start. And it's likely we're going to get a continuance of poor earnings and guidance. And that is very likely to spur a new leg down in the market. But we'll see. They might. It doesn't look like they're all going to start seeing it's going to be roses and unicorns and, and rainbows going forward. But you never know. The next one is the yield curve. So in a healthy economy, the yield curve slopes higher, and the reason is that for longer term debt, it demands a higher yield to offset the longer term risk. So you'll have shorter term yield curve is going to be lower interest rates, and the farther you go out, you have higher interest rates to adjust for the risk. So, and when you have a steepening curve, it's typically showing the expectations for stronger economic activity, higher inflation, and higher interest rates. And when you have a flattening curve, it means that investors expect near-term rate hikes and are kind of pessimistic about economic growth. So heading into Friday, data showed that the 2-year note was at 2.92% versus 2.98% for the benchmark 10-year Treasury bond. So it's really close to inverting, and it did briefly invert last month, and that's what's also gotten investors pretty worried about what's going on in terms of recession going forward. And the U.S. curve has inverted before each recession since 1955. And with the recession falling between 6 and 24 months later. So that's a real big concern going forward. The next one is interest rates. The Fed's expected to raise rates by 75 basis points. That was kind of a shocker last month that they did 75 instead of 50, but I think the market's actually liking that. If they were to come out with a 100 basis point hike, we'd probably get a pretty big rally going on because they're figuring that the pain's going to end sooner than later and we can all go back to making tons of money. So, but the investors are also concerned by Powell's seemingly sort of glass half full comments about the economy as being really too optimistic and too Pollyanna-ish. He's been recently describing consumer spending as, quote unquote, strong, and amidst, quote unquote, no sign of a broader slowdown in the economy. But it's adding to investors' concerns that the Fed's behind the curve and is going to be making a major policy mistake by either leaving interest rates, cranking them up too high and kicking the economy into a massive recession, or just kind of failing to do that, backing off, and then causing inflation to just keep going higher and higher. So that's the big one. The yield curve and interest rates are the two, probably the biggest ones looking forward that investors are looking for. And then finally, the last one is the unexpected event, which is probably likely. So if you kind of add everything up, right now we have the fastest inflation in 4 decades. We have an aggressive Fed, and we're in a stock market bear market. So all these things would normally presage a economic downturn. So now the downturn may be avoided, but there's almost all these downturns when they start, or recessions, things come out of the woodwork that were kind of there, but was being trying to paper it over. We recently saw one of the big crypto hedge funds that had to be liquidated, and that's not doing any good for the crypto market. And so one of the main ones, just in recent history, is that no one saw the 2007 to 2009 financial crisis getting as bad as it did, and one of the problems with that was the Fed. The Fed doesn't have a good record of sort of doing the right thing or just looking at the wrong data, or almost just like they're this institution that doesn't really live in the real world. So back in 2008, the Fed saw maybe something was going on, but they just kind of raised rates a little bit back then, mostly to take out the froth out of the housing market, which of course was just going gangbusters. Does it sound familiar with what's going on today? Maybe a little bit different picture in terms of why the prices are going up then versus now, but thing is, we have an even bigger bubble in housing right now than even before. So those little interest rate hikes didn't do anything, and housing market, of course, collapsed. But the whole time they kept saying that, the issues were coming from subprime and that there was no problem there. The problems were contained. There really isn't anything there. And they were absolutely wrong. So they just missed it. And you think, here's an institution that is just filled with, PhDs in economics and super smart people, and they just didn't get it. So that's the thing. There's likely, the more that the market continues down, that there's going to be some unexpected event that's going to appear. Now, what is it? Crypto could be another one. We've already starting to see the pressures going there, especially with that hedge fund. We've seen some of the currencies just go to zero out of the blue. Now they're starting to do, trying to fix it by using math and other things that are behind the cryptocurrencies to prop them up. All sorts of stuff's going on. It's not painting a good picture for that right now. The other one is, it could be maybe the MBS market, the mortgage-backed securities. And the Fed has bought a ton of those for its portfolio, and they're starting to liquidate that. That may just cause a lot of problems because there may be nobody on the other side to take the other side of the Fed's position. And then finally, could be just the quantitative tightening. The Fed has just trillions of dollars of stuff they're trying to get rid of, which they need to. But one of the things that could come out of this is that interest rates could just rocket higher because it's like the free market can finally set the rates that were held down for many years by the Fed, just buying and buying and buying and pushing everything down. So that could just be the unexpected event. I mean, nobody knows, but those are just kind of maybe three of the ones that are maybe out there lurking, or just could be something that nobody knows. It could be a COVID variant. We just don't know. But it's that's something that's also weighing on the market, that there's likely something else out there. Okay, so that's about it for this week. The market's it is struggling and it's trying to find a bottom. Whether it will soon, nobody knows. But at this point, you're best either out of the market, and per our system, you are out of the market. There's no reason to always be in the stock market. Of course, if you have money in retirement funds, you don't want to mess around with that. So you want to be extra cautious. We are out, so at this point, but at any time the market can turn on a dime and become very bullish very quickly. Sometimes those are fake outs, but of course, one of these times it will be the bottom and a fantastic buying opportunity to make money very quickly and to sort of get back any money you've lost by sitting through this pretty ugly bear market so far, especially in the NASDAQ. Okay, well, we'll be back next week. Have a great weekend. Okay, talk to you soon.